Hi everyone, welcome to our third video in the adjusting process. Here we're going to be looking at just additional examples. We'll be looking at journal entries, posting to the T accounts, and we'll also look at a worksheet as well as creating financial statements from a worksheet. So let's start with looking at some transactions. And from these transactions, we're going to skip the journalizing process and try to take this information and put it directly into the T accounts. Now, we know from our readings that journalizing is the first step. So we read the transaction and then we journalize the information. And then we move the journal entries to the T accounts in a process called posting. However, in this case, we just want to look at these transactions and see if we can put this information directly into the T accounts. So let's take a look at those T accounts that we're going to need. So I'm giving you the T accounts with some accounts with beginning balances already. So in the yellow block there, we have the transactions from the prior screen, and we're going to go through these one by one. So let's start with service revenue accrued of $600. So first we have to remember what accrued means. So since this is service revenue that is accrued, that means that we have earned this service revenue, but we have not yet been paid for this service that we've provided. So that is going to increase accounts receivable, because accounts receivable is an asset signifying that someone owes us money, but we've earned it. So remember, under accrual accounting, we have to record the revenue even though we haven't yet gotten the cash. So revenues will also increase, and revenues increase with a credit. So again, we would debit our accounts receivable account and credit service revenue. Again, always note that debits are equaling credits here. So let's look at the next one. Unearned service revenue that has been earned. So this is like the second step of a process here. So we have to kind of think back what happened first. Well, the unearned service revenue was created first. And we remember that an unearned service revenue is a liability account. Therefore, what happened, someone gave us cash for something that we had not done yet. So in the first step, we credited the liability, unearned service revenue, for $200, and we debited our cash account for $200. Because remember, someone gave us cash for something we had not yet done. So it created a liability for us. Now we are actually earning that cash that we've already gotten. So we no longer owe it, so we've got to take it out of the liability account. And liability accounts decrease with debits. So we're going to debit the unearned service revenue liability account. And we also have to have a credit here. Well, we are now earning this cash that we've already received. So now we will credit our service revenue account as well. So again, you can see debits still equal my credits. The third one is a little different. It's telling us that supplies on hand are $900, and the beginning balance of supplies was $1,000. So if you look here at the supplies account in the middle of the screen, I've already got the beginning balance there for us. And what they're telling us is we ended with a $900 balance. So we have to think, well, how did we get from $1,000 worth of supplies to only $900 worth of supplies? We must have used up some of our supplies. So the supplies account decreased. Supplies being an asset, it will decrease with a credit. So we're going to credit the supplies account for the difference. We used up $100 worth of supplies, so we'll credit supplies for $100. But what's the other side? What's the credit? What's the debit? Sorry, what's the debit to this transaction? Well, when we're using up an asset, the using up of an asset is an expense, and we have a supplies expense account. Okay, so we'll debit the supplies expense for that $100. So you'll notice here that we still balance. Our debits still equal our credits. And the last one, salary owed to employees, $400. Well, If it's owed to our employees, that creates a debt to us, a liability. And since it's salaries, we'd call that salary payable. So we owe $400. We're going to credit the salary payable account for $400. And we now owe them this money, so that expense needs to be recorded. Even though we haven't paid them yet, accrual accounting says we record expenses when they're incurred. And they have happened, so we have to record them. So salary expense will get debited for $400. So again, still, our debits equal our credits. Even though we didn't make the journal entries first to really see that, we can still see it here in the T accounts that debits still equal our credits. Now let's look at a partial worksheet. So this is the same company with additional accounts. And you'll see we have a trial balance here. The trial balance takes place before those adjustments that we just made. And we do a trial balance to ensure that all of our debit account balances added up equal all of our credit balances added up. So you can see here down at the bottom, they both total $116,000. So we're happy that those balance. Now, we cannot be 100% sure that we still did everything correctly. This is just telling us that debits equal credits. But if we happen to debit the wrong asset account, instead of cash, we debited supplies, or vice versa, the debits and credits would still balance, but we have numbers in wrong accounts. So you still have to be cognizant and a little bit investigatory, I guess you would say, to make sure that everything is still right. But the debits equaling credits still gives us a bit of assurance that we're on the right track. Now, we're going to take those adjustments that we just made in the prior T accounts, and we're going to put those in the adjustments columns. And this is what that would look like. Okay, so the first one we'll look at is the service revenue and the accounts receivable. So that was the $600 number. The 200 is in there as well because it affected the service revenue, but we'll get to it in a second. So this is a $600 credit to service revenue. So we earned some revenue on account, or we accrued service revenue. And we debited accounts receivable and credited service revenue. Okay, so we would put those in the adjustment columns appropriately. Supplies, we credited supplies for 100 and debited supplies expense for 100. So if we put those in the appropriate lines, so we're just moving them from the T accounts to the worksheet. Okay, then we debited salaries expense for 400 and credited salary payable for 400. So again, we're just going to move that now to the worksheet. So again, a credit to salary payable, debit to salary expense, and you can see that right there on the worksheet. And then the last one was unearned service revenue. We debited for 200 and credited service revenue for 200. So I'm just going to move that again to the worksheet. And then I'm going to add my columns down to ensure that they balance. So we can see that each column balances to $1,300. So again, we're happy, but again, cannot be 100% sure that we put everything in the right account, but we are happy that they balance. So what I'd like for you to do now is I want you to press pause on the player here in just a second. And I want you to move the numbers across to the adjusted trial balance. So remember, the trial balance, or the unadjusted trial balance, is the first trial balance. It balances all of your accounts prior to adjusting. Then we make our adjustments, and then we have a new trial balance called the adjusted trial balance. So for example, the cash account has a debit balance of $6,000. Adjusting entries never affect cash. So that $6,000 balance will simply move over to the adjusted trial balance debit column. Accounts receivable had a trial balance debit balance of $5,000. Then we made an adjustment to that account of a $600 debit, which made that account increase. So now the debit balance under adjusted trial balance would be $5,600. So I think that gives you a good start here. So press pause, give yourself a few minutes to finish this adjusted trial balance, then come back and we'll take a look at the answer. Okay, hopefully you've had time now to complete the adjusted trial balance. So let's take a look and see how you did. So you should have found the debit balance in your adjusted trial balance to be $117,000 and your credit balance to also be $117,000. Now, what I'd like for you to note is you cannot simply take the balance or the balances from the trial balance of $116,000, add $1,300, and get the answer in the adjusted trial balance. That doesn't work. The reason it doesn't work in this instance is because we are not increasing all of our accounts. Some of our accounts are decreasing, and that messes that philosophy up. Okay, so don't automatically think you can just add those numbers on that total row down there to get the adjusted trial balance solution. It will not work, so don't do that. In most cases, it will not work, especially if accounts are decreasing, not increasing. All right, so let's look at a new company here. Mary Maid's company, the cleaning service, started the preparation of its adjusted trial balance as follows. During the 6 months ended June 30th, Mary Maids did these following things. So what I'd like for you to do now is to press pause on your player again and journalize these transactions. Then once you're finished, come back and we'll take a look at the answers together. All right, let's take a look at the first one. Used supplies of $1,500. So we're using up our supplies, which is an asset account. And when we use up an asset, that's called an expense. Okay, so we're going to debit supplies expense and credit supplies for that amount. Supplies are decreasing and we're increasing our expenses because we're using up an asset. The second one, used up prepaid insurance of $600. Now remember, prepaid insurance is an asset. We've paid something in advance, so someone really owes us something. In this case, it's insurance. So, but now we're using up this asset. So again, that creates an expense. This happens to be insurance, so we would call that expense insurance expense. So prepaid insurance is going down, that's an asset, so we're going to credit prepaid insurance and debit insurance expense. The third one, we used up $500 of the equipment through depreciation. Now we've talked a lot about depreciation journal entries. Remember, the journal entry is always the same. You debit depreciation expense, you credit accumulated depreciation, whatever the asset is. So in this case, depreciation expense of $500, and we're depreciating a piece of equipment, so we would probably call that accumulated depreciation equipment. The fourth one, accrued salary expense of $300 that Mary Maids hasn't paid yet. So again, we're accruing salaries that we have not yet paid. So that creates a liability for us, but we still have to record the expense because we've incurred it. So we're going to debit salary expense and credit salary payable. And the last one, we earned $400 of that unearned service revenue. Well, again, this is one of those things you have to think about what happened first. So we received cash in advance of doing anything. So we debited our cash account and credited unearned service revenue, creating a liability, increasing that liability. But now we're earning it. So we no longer owe $400 in that unearned service revenue account. So we have to take it out of that liability. So liabilities decrease with debits, and we're earning it. So our revenues are increasing, and revenues increase with credits. So we're going to debit the unearned service revenue and credit service revenue. Now we're going to take this information, these 5 journal entries, and we're going to put them into another worksheet for Mary Maid's company. So keep this information handy. So here's our worksheet. So again, I'm going to let you do this one on your own. So if you would, press pause on the player, go ahead and fill in the adjustment accounts like we did before, and then carry the information from the trial balance, the adjustments, into the adjusted trial balance. Get your totals, make sure debits always equal credits, and then come back and we'll check your answers together. Okay, hopefully you've had time now to complete the worksheet. So let's take a look at what those journal entries that we just made would look like in the adjustments column here and what they would add up to. So if you did these correctly, you should get an adjustments columns balance of $3,300, and you can still see that our debits equal our credits in those columns. The next step would be to take the balances in the trial balance columns, add or subtract the numbers in the adjustments columns to get our adjusted trial balance columns numbers, okay? So if you did that correctly, here's what your numbers should appear. Okay, so you should have ended up with a balance in your debit and credit columns of $36,500. If you didn't, make sure you look back at these numbers and see where you went wrong. And hopefully it'll become more clear at that point. So once again, remember, you cannot simply take the trial balances, add the adjustments balances to get the adjusted trial balances. It doesn't work that way in most cases. So don't automatically assume that. All right, so now we're going to take these numbers in the adjusted trial balance columns, and we're going to create financial statements. So keep these numbers handy as you're going to need them here in just a second, okay? So what I'd like for you to do is to take that information from the trial balance on the prior screen, and I want you to create an income statement, a statement of retained earnings for the 6 month ended June 30th, and I also want you to create a balance sheet on that specific date. I'd also like for you to be able to draw arrows linking the 3 financial statements because they do tie together in some way. So again, press pause and go and see if you can create these 3 financial statements. Come back when you're done and we will check the answers together. Okay, hopefully you've had time now to create these 3 financial statements. It's very, very important that you practice this. So give yourself the opportunity to do that so you can hone these skills. All right, so I'm going to show you all 3 of them at the same time, and we'll see how these 3 financial statements are linked together. So the first financial statement you really need to create or must create is the income statement. And remember, the income statement is revenues minus expenses equals net income. So revenue in this case was $22,400. You subtract all of your expenses, which totaled to $10,900, and that gives us a net income of $11,500. Now, you don't need to remember this right now, but in future, keep in mind that really what we have here is operating income because we don't see taxes, and net income typically means taxes have been taken out. But for our purposes right now, our net income is $11,500. The second financial statement we can make now is the statement of retained earnings. If you think back to your T account for retained earnings, that's really the statement of retained earnings itself. We start with beginning retained earnings. Net income makes retained earnings go up. If we have a net loss, it would make retained earnings decrease. Dividends make retained earnings decrease. And then we end up with ending retained earnings. So in this case, we started with beginning retained earnings of $5,000. We just calculated net income in our income statement. So you'll notice that $11,500 from the income statement moves down into the statement of retained earnings, increasing retained earnings. And then we paid dividends of $4,000. So beginning plus net income minus dividends gives us ending retained earnings of $12,500. The last financial statement we can make in our series here is the balance sheet. So we have assets equals liabilities plus owner's equity. So remember, that's also the accounting equation. Also remember that the income statement and statement of retained earnings are over a period of time, and the balance sheet is as of a specific day in time. It's a snapshot. Okay, so our assets In this case, we had 4 assets, but one of them is a depreciable asset, which carries a contra asset account along with it, and that's accumulated depreciation on the equipment. So remember, the equipment itself stays on the books at what we paid for it. However, we depreciate it over time in the form of accumulated depreciation, and that account effectively reduces the book value of that equipment. So even though we keep the equipment, as you can see here on the balance sheet, at its cost of $20,000, the book value is only $16,500 because we've depreciated that asset. So that gives us a total assets on the balance sheet of $18,100. Then we have our liabilities. We had 3 of them. They totaled $2,600. And then we can do the owner's equity section, which included, or stockholders equity section, whatever you're more comfortable calling it. Common stock was $3,000. And then we have retained earnings, which is part of owner's equity. Okay, so that's what the company retains and doesn't pay out in the form of dividends. And we calculated that number on the statement of retained earnings. So you can see that $12,500 came from the ending retained earnings on the statement of retained earnings. So it just moved over there, giving us an owner's equity section of $15,500. So the $18,100 in assets should equal your liabilities plus owner's equity. And $2,600 in liabilities plus $15,500 in owner's equity does give us a $18,100 balance, which equals our assets. So hence, we balance, so we're happy. Thank you for watching my video. I hope that you learned something new. Please give my video a thumbs up and subscribe to my channel so that when new videos are posted, you can be notified. Comments and questions about my videos are always welcome. Also, please visit my website at www.theaccountingdoctor.com, and there you can find additional videos, lecture notes, accounting games, as well as my blog. See you soon.